Okay, if inflation stays above 6%, that warrants some monetary tightening. So Reserve Bank of India Governor last evening surely has poured cold water on all rate cut expectations. So certainly 50 is out of the window. And now the debate is on whether on 19th of March we'll get 25 or not. Let's discuss the importance of RBI credit policy with Chetan Iyer, Managing Director, Asia Pacific Economist with Morgan Stanley. Chetan, do you think Reserve Bank of India yesterday has poured cold water on expectations of a rate cut?
Well, I don't think it's that comment which alone makes that view for us. But we do think that RBI will probably skip rate cut in this meeting because CPI numbers are still pretty high. And we have lately been focusing more on CPI than WPI because we think that is one which determines the inflation expectations for the households. It is also determining the allocation of saving for the households into financials and physical savings, which is that if the real deposit rates are negative, they'll prefer to buy gold more than putting money into the banking system as deposits. So all in all, looking at CPI inflation, current account deficit, low deposit growth, we think that it's time to still hold on the rates before we go and make another rate cut. And in fact, if you just see what happened post last rate cut, RBI cut policy rates by 25 basis points, even CRR, and then banks went and, particularly SBI, went ahead and hiked deposit rates. So we haven't really yet achieved a stability in the financial system where we can go ahead and do more rate cuts in our views.
Chetan, you've slashed your FY14 GDP forecast from 6.2 to 6%, but after a sub 5% print for the quarter gone by, which is Q3 of this financial year, some would say even a 6% for FY14 could be a tall order.
Well, I think if you just adjust the last quarter's number for two aspects, one is a statistical adjustment in the deposit growth and credit growth calculation, and second is what is going to happen to the farm output. We are already at 5% for the quarter ended March 2013. So taking up from there, we don't think it will be challenging to achieve a 6% recovery. But yes, of course, there are still a lot of uncertainties around that number. Particularly on what's going to happen to government's policy action to revive investment. But at this point of time, we think a 6% number is not really an aggressive forecast to achieve. And we think it is going to be possible to achieve more via recovery in exports, which we tend to underestimate because, yes, net exports for India is not a big driver. But at a gross level, exports are 24% of GDP. And that had been quite weak for the last 24 months. And now we have seen that since July, sequentially exports have increased by about 19% on a seasonal basis. That's a massive increase in exports which has happened on a sequential basis. And it will show up in the YOY numbers even more going forward. And then when you look at the outlook for the developed world, our team is quite constructive on what's going to happen in the US and Europe from the third quarter of this calendar year. So we're expecting a significant recovery in the US, which we think will begin to help our exports even further. So we are looking for a 13% growth in dollar terms in exports in March 14 financial year versus about 4% decline in March 13 financial year. So that will be one big factor which will support the recovery. And we have also observed a very high level of linkage of exports to the capex in the past. So yes, there are other aspects which drive capex, but one simple driver that tends to support capex is exports recovery. So both these factors together, we think will support that gradual recovery in growth rates from 5% in March 13 towards 6% in financial year March 14.
Chetan, hi, morning. Just to stretch that point that you were just making, capex cycle, sure enough, has completely stalled almost. What instruments can the government actually take to revive growth?
Okay, I think as I mentioned, one is exports and second is the market-driven improvement in capex because of improvement in external demand. But I think from the government side, what it needs to do is to really focus on try and accelerate the approval process for projects which are stuck. And the government has already begun to do that, but it needs to be at it. We can't drop the guard on that front. The enabling policy environment from the government will still have to continue to come through. And that's how we will get the recovery in capex going forward.
Chetan, you've also stated that fiscal consolidation is going to help reduce macro stability risks. How confident are you on the government actually delivering on fiscal deficit targets? And what's your view on the quality of fiscal consolidation as well coming in?
Well, if you look at the way the government is handling, we are actually seeing some concrete measures being taken. The first one being is that we have seen increase in fuel prices, which is directly going to help reduce the subsidy numbers. The second one is that we have seen a reduction in the expenditure growth, which has in fact since September been coming through quite meaningfully down. So if you look at the expenditure numbers excluding interest and subsidy, those are growing at about, that's growing at about 4% since September to date. And in April to August, it was growing at about 11.4%. So we've seen a meaningful reduction in expenditure growth in these few months already. So that's what is really going to, I think, combine together with the fuel subsidy reduction, help us to achieve the fiscal deficit reduction, which the government is talking about. It could still be somewhat higher than the government's target, but we do think that the fiscal consolidation is underway.
But Chetan, do you think Finance Minister has been rather optimistic with his budget assumptions? He expects tax growth of nearly 18-19%, which clearly means that he's betting on a strong economic recovery.
So, yeah, I think the tax revenue growth numbers may look optimistic if we just look at it on the basis of just the growth rates. But the driver to that is twofold. One is that there has been an increase in corporate tax burden, which is a small one, but that's helping to justify the tax revenue growth for corporate taxation. And secondly, on the other measures which the government has announced in the budget is that they have announced that for services there will be a voluntary disclosure scheme, which is an amnesty scheme. That will also help increase the services tax revenue. So, yes, you could say that it is slightly optimistic, but we don't think it is so optimistic that the deficit numbers will go out of calculation from what they are presenting.
Chetan, in the past, when we've interacted, you've done some work on banks and the asset quality of Indian banks. What are your thoughts there now?
Well, I think the asset quality issues still persist, and the challenge for the banking sector, particularly on the SME side, is that when you have GDP growth which has been at a very high level of 8.5–9% for a long period, and then you have a slow growth environment, that tends to have an impact on the asset quality. So the fact that the growth, even if it recovers to 6%, will still be relatively low compared to what we were having in the past. Asset quality challenge will still persist with us for a while until we see growth rates coming back to around 7% levels.
Chetan, I mean, given the macro picture that we're talking about, when do you see the currency actually turning around? Because that weakness has been impacting possibly everything, and even the equity market performance back home.
So firstly, I think we've had to give the confidence to the developed world that yes, growth in India will stabilize and probably begin to gradually recover. And the government's actions have built that confidence, and we are seeing capital inflows being stable, helping the currency to stabilize as well. So I think that factor has already helped currency stabilize. But going forward, a sustainable improvement in currency dynamic will have to be done by reduction in current account deficit, which also will probably happen, but it's going to be quite a slow process. And I think the way it happens is that we have increased fuel prices, so that will work on the oil imports. As CPI inflation goes down, which we think will happen in the next 4 to 5 months, you will begin to see that impacting gold imports as well. So these two factors alone will help the import side. And on the export side, we have, as I mentioned, seen improvement in exports earlier. And going forward, it will probably be helped with the recovery in the US. And therefore, the current account deficit, we think, will go down. It will be at about 6% in December quarter. But after that, it will begin to come down as percentage of GDP. And that's what really will then begin to support currency dynamics.
So, Chetan, your 6% GDP number for FY14. Which way would you leaning? Do you think it would surprise us on the upside, or it could still disappoint us? Is that an optimistic assumption, or that is a slightly pessimistic assumption?
We think it's a realistic assumption, Nikunj, because risks on that forecast are near balance for us. So we'll be looking at no specific bias to this number. and we think it's a realistic target to achieve 6% growth.